Thank you for watching and listening to Dollar Gains. I am Nathan, and today we're going to review some financial statements. Yes, this sounds very boring, but when trying to make money, trying to get a loan, this may help. So we're going to start with income statements, and we're going to relate it to getting a loan. And of course, this is a picture that's on our Facebook page. The income statement. Basically, this is showing where all money is coming from for either inside the house, inside the company, if you're looking to invest in some sort of stock or some sort of business. This is showing where all the money is coming from. Any kind of interest from a 401k in a private investment, a rental property, side job, etc. And this is also true for any businesses. If a car selling business also sells insurance for the cars, like warranties, that's another source of their income, and this will all be on the income statement. And these are three things, as I said, that all banks look at before loaning, and I would recommend everybody looking at before investing in stocks of any sort. Moving to the statement of cash flow. Now, this is an extremely important statement because a company, in theory, can run at a deficit multiple years as long as they have cash flow. The example is if you're in a house and your car breaks down 6 times that year and you spend more on the car and your living expenses than you made that year, you put them on credit cards or took loans out. So as long as you had that cash flow from those credit cards and those loans, you're able to vet those costs of that was just an abnormal year. Companies do the exact same thing. As long as they have the cash flow required, they will stay afloat, even if they're losing money year over year. They'll usually liquidate or sell off that side motorcycle if it was an individual, or they'll sell off that underperforming storefront, like how you see a lot of these companies before they go under in retail, selling off certain stores, liquidating to try to keep that cash flow high. Moving to the balance sheet. Balance sheet is very abstract. It kind of takes the overall net worth of either a company or an individual. This consists of anything that you can sell to liquidate or show wealth, right? So you got 10 cars, every car is worth $10,000, you got $100,000 in net worth. Same with companies. If companies have a lot of cars that they own or a lot of plants that they own that they could sell, that shows on their balance sheet, as well as liabilities. So balance sheet is literally how it sounds, balancing between liabilities, things that cost you money, like a liability would be the insurance on your car, the note on your car, the other side, the asset side of that vehicle would be how much equity you have. If it's a $10,000 vehicle and you only owe 5 on it, you've got $5,000 equity. A balance sheet really just shows if a company can liquidate things if they need to liquidate, and so that they don't get over leveraged. Over leverage is just a fancy word for saying, oops, we borrowed too much. I hope you like this video. If there's any questions, you want to elaborate on anything, please message us, private message us, however you need to get a hold of us. This is posted on YouTube and on our Facebook, this video and this picture. Thank you for listening. This was Nathan.